All right. I think this is working. All right. So if anyone is on, just let me know if this is actually streaming. It looks like it is. Ooh, that's a little spiky. All right. So welcome to my first live stream where we're going to get into a bunch of your questions that you all have shared with me. Super excited for this. And yeah, and if you have any questions, just go ahead and post them on the live chat. I'm going to first cover a bunch of questions that I've already received through other social media platforms, previous videos, all that good stuff. So yeah, let's get into the first question over here. And forgive me, I'm a little bit slow figuring this all out. Never actually done this whole live stream thing before, but excited to have a whole conversation with you all about important things that we're all trying to figure out as we go. So the first question that I wanted to start with that I received is, how does this topic regarding inflation and deflation impact all of us? Why is it important? So this is, I think, a perfect question to start with, and it puts everything into perspective. The reason why it's so important is because we're heading into a very big debt crisis. And the question is, how is that debt crisis going to manifest? How is it going to be felt, and what kinds of strategies are going to be good for people to implement in this kind of environment? And with the emergence of massive monetary and fiscal policy, a lot of people think that the way this debt crisis is going to be felt is going to be very inflationary. And central banks are going to print money into oblivion, and governments are going to be doing crazy amounts of stimulus, and this is going to crash the value of the dollar and also the debt, the value of the debt. Because let's say you have $27 trillion in debt, and now the value of the dollar goes down by 90%. Well, now the burden of your debt has also gone down by 90%. And so that's the inflationary argument. And in this case, really owning anything other than cash or bonds are going to do at least all right. In past hyperinflationary events, we've seen the things that perform best are commodities, hard assets, whether that's real estate, precious metals, things that have fixed supply and utility basically in any kind of environment. Stocks, they usually underperform, so they go up like everything else does. But given the economic implications of a inflationary or very inflationary environment, borderline hyperinflationary environment, stocks don't perform well, and they don't catch up to the real return. So they might be gaining hundreds of percent, but if the currency that those stocks are denominated in are losing thousands of percent of value, then you're still losing value in real terms. So that's why a lot of people are still very bullish on gold. Somehow real estate prices continuing to go up, and also stock prices continuing to go up, because they believe that the dollar is in this kind of slow motion free fall where it's just going to crash. Now, the other side of the argument is the deflationary argument. And this warrants a completely different strategy. Again, we're heading into a debt crisis. The question is, how is that debt crisis going to unfold? And how is that going to be felt in the real economy? How is that going to impact us and our financial situations? Well, in the deflationary side, the problem is, and what people are talking about on that side, is that the mechanism for creating new money and just printing the dollar into oblivion doesn't exist. What central banks can do, and like the Federal Reserve, they can expand the monetary base, which is the full amount of money that's in existence, but they can't directly take that money and put it into the real economy. Banks have to do that. So it's kind of, the banks are the middleman. And if the banks don't see financial upside in taking that money from the banking system into the real economy, then you don't have that kind of price inflation. And the way I think of it is, well, yes, we are seeing inflation. The monetary base is inflating. The total currency supply is inflating. But if you take that, let's say the Federal Reserve was like, okay, we're going to do massive amounts of quantitative easing, and we're going to print the dollar into oblivion, and we're going to put all that money on excuse me, on the moon. Well, let me put this on silent. Would that have the inflationary effects that we would expect from massive amounts of the supply of money expanding? No, it wouldn't, because none of that money is in the real economy that's boosting up the relative price of goods and services. That money is not being felt, and so it's not going to have those inflationary effects. So given that, that's how I see what the Federal Reserve is doing right now. It's basically, they're creating more money in the system, but if that money is not entering the real economy, it's not going to have that inflationary effect. And so that's why in my last video, I talked a lot about the inflation factors, and a lot of those have to do with changing the system. If the Federal Reserve, or if the government, amend the Federal Reserve Act and change the way that the Federal Reserve can actually, I guess, use their monetary policy tools in order to actually take money and put it straight from the banking system into the economy, then that could be inflationary. And so on the deflationary side, a debt crisis, when you have deflation, it's basically deflating the debt away. And so prices of everything go down. You have an insolvency crisis where you have lots of businesses and corporations going bankrupt because they're not able to continue to pay their expenses and their liabilities and afford the debt. And this is pretty important, because right now companies are extremely leveraged. They're using a lot of debt in order to stay in business. And so if there is a debt crisis, or if there's a crunch on the amount of money that's entering the system, then these businesses aren't going to be able to sustain their current way of operating. And so this is why, yeah, we're entering a crisis, but it's really a question of how that crisis happens, and it's going to be completely different. Are you going to be having money, printed into oblivion where it's on the street and it's basically worthless? Or are you going to have a situation where you have a kind of Great Depression kind of deflationary environment where credit and the supply of money contract, and people are really struggling to just keep a roof on their heads and continue to access enough money in order to pay the debt? Because if you think about it, let's just say, for example, in a deflationary kind of crisis, what you have is, let's say you have $100 of debt in the system. There's always more debt than there is money, or currency. It's not really money. The way that it happens is, let's say you have $100 of debt and you have $50 of currency in order to pay off that debt. Well, in a deflationary environment, in order to pay off the debt, you have to use that currency. And so you take $10 and you subtract $10 of debt. So now you have $40 of currency in the system, and you have $90 of debt still in the system. Let's say we were to pay off $40 of debt. So now there's only $60 of debt left in the system. How much currency is there left in the system? Where there's only $10 left of currency. And so you can see that the relative amount of currency, the ratio between currency and debt, starts to really go down. And that creates, even though there's no more debt in the system, the relative burden of that debt becomes astronomical. And this is where you can have that kind of terrible deflationary event that puts people, that really kicks people down and makes hundreds, thousands of businesses go bankrupt. And this is why it's really important to understand the difference, because yes, we're heading towards a debt crisis, but the strategies in order to survive and thrive that kind of crisis are going to be very different depending on how it actually comes down. And a lot of people are just assuming, well, the government and the Fed don't want asset prices to go down. They're going to continue to support it, print money. And so I'm just going to buy into that and just ride it all the way up. Well, I would agree with that, but there are also so many costs with a hyperinflationary kind of deleveraging where you print, trillions, quadrillions of dollars. And now that $26, $27 trillion of debt is nothing, because now the value of the dollar is basically worthless. There are a lot of costs with that, and that would come with a currency crisis all around the world, because we have to remember the US dollar isn't just important when we're looking at the domestic economy. We have to look at the US dollar and also consider the worldwide implications and understand that it's the world reserve currency. And so much of the debt in our economy and the world economy is denominated in US dollars. And so it's not just looking at the US, we have to look at the whole big picture. So that's kind of the difference between, or the reason why this is such an important topic, because you can approach this kind of problem very different ways when we're looking at an investment portfolio. If you think inflation is coming, then you can take, stock in precious metals, stocks, real estate, and look to continue to basically short the dollar by holding those hard assets. If you think deflation is the concern, then you're going to take a much more risk-averse stance by holding cash, maybe super high-grade treasuries like long-term treasuries, but really just try to stay as liquid as possible in cash. Now, again, both sides that think inflation is going to be the thing where the government's going to print the dollar into oblivion, and deflation where there's going to be a massive kind of Great Depression event where debt collapses onto the dollar, both understand that it's going to be really tough either way. And so it's really important to kind of understand the nuance between these two, because it's going to make a big difference. Now, no one knows for sure what's going to happen, but that's kind of the rundown between the inflation-deflation debate and why it's important to us. So the next question that we have here, why do you say that the biggest concern is deflation and not inflation, even though prices at grocery stores and the cost of living is going up and not down? Well, this is a great question. And the reason why I'm talking about deflation, again, I look at things from a very big perspective, more of like a macro view. And so, yeah, we're seeing the cost of living go up, and we're also seeing prices at the grocery store go up. Well, what we have to understand with the inflation-deflation debate is that inflation and deflation, we're just talking about the supply of money and credit. And so let's say, for example, the supply of money goes down by 2%. And credit really starts contracting. But let's say there's a food shortage. And so the supply of milk and eggs and fruits or vegetables, those go down by 30, 40%. Well, in that scenario, sure, the supply of money is going down, which is by definition deflationary. But that supply shock for essentials is much larger, much more impactful than that supply of money. So you might have a deflationary scenario where the prices of essentials actually go up because the supply shock is greater, or the demand is just always there. Regardless of what kind of scenario we find ourselves in, we're still going to need to purchase essentials for living, whether it's, things at the grocery store, toothpaste, gas, just like the essentials for us to continue living our normal lives. The problem is that while those prices might be going up, prices in other parts of the economy, let's say like discretionary goods, going out for dinner, things that aren't essential, those prices might not just go down in a deflationary environment. They might disappear altogether. And this is where we get into bankruptcies, where there's just not enough demand, and we're having large sectors of the economy disappear because of this kind of debt crisis. So yeah, it really comes down to supply and demand. You might have certain sectors that are still going to perform well because the demand for certain things aren't going to go away. And some, with what's happened in the past year with the pandemic and everything, it's really impacted supply chains. And so it's made it really difficult for a lot of goods and services to continue to be offered in this kind of environment, which has lowered the supply that those goods and services can be available to others, and therefore the price goes up. And so we might have certain parts of the economy actually go up in price, and others go much further down, or maybe even disappear. So big important kind of thing to consider there, because when we're taking our dollars and we're not spending on certain things, and we're maybe spending a higher percentage of our dollars on essentials, that's boosting demand on those essentials. And so it makes sense that we are going to see a price increase in certain sectors. And that's why we could actually see consumer prices continue to go up while other prices go down and markets go down. Because again, let's say something really tough happens and your income is cut, or you're not making as much money, or kind of emergency. You're going to take your most liquid investments first in order to continue to service your debts, or in order to continue to pay your rent or mortgage or car payment or whatever. You're not going to hold it in Tesla or Bitcoin. So that's kind of the concern from a deflationary standpoint, that we could see a big crash in a lot of asset prices in order to wipe out a lot of that bad debt, especially if there's not a mechanism to actually create inflation the other way, and print the dollar and just kind of do this kind of debt jubilee thing. And that's why it's so important to understand the nuance around how money is actually entering the system and whether or not that's actually inflationary. So we'll get into more of that in just a bit. So the next question we have here. So what's the best and worst scenario for the future? Okay, so the best scenario, again, we're heading into this kind of debt crisis. So the only scenario where we can kind of avoid this debt crisis, or maybe even, just coast over it smoothly, is where we have a big economic recovery. And so this is where, again, like I talked about in my last video, the important things for inflation. Now, not just prices going up, but new money entering the system and credit expanding. That's a big thing. So if we start seeing credit expand, consumer spending go up a lot, and the economy actually starts fundamentally recovering, things open up, businesses, all these regulations and shutdowns, all of that is swept out, and we not only recover to where we were before, but really have this kind of economic boom, which will be able to be measured in the data. We can confirm whether or not we're having a substantial recovery if we see in the data. That's the best scenario. The reason why is because if you look at kind of like the balance sheet of the US, you have income, which can be measured through GDP, gross domestic product. That's kind of the income for the US. And then the liability side of the balance sheet is the national debt. And so in order to continue to be able to service that debt, you either have to lower your expenses or increase your income. So we need to either see the debt go down, or not go down as much, or not go up as fast, which we're seeing the opposite. Debt's increasing at an ever increasing rate, which is really concerning. But we're also seeing GDP go down. Now, we did have a little bit of a recovery from the trough back in March, April, but again, we're way down and we're way off pace from where we need to be. And so the best scenario is where we have a massive boost in GDP, the economy opens up, and we don't only get back to previous levels of economic growth, which were already kind of stagnant and in decline, but we get back to not just 1-2% growth, but 5, 7, 8, 10% growth sustainably, and we see the economy really recover. And also we need to start seeing the GDP increase quicker than the debt, because again, that it's not sustainable for the debt to continue to increase faster than the GDP. And this has been a trend that's been going on for decades. And so that's the best scenario, where we don't see an inflationary deleveraging or a deflationary deleveraging. We see steady inflation, but nothing too high, and we get really big economic growth, which will enable the U.S. at least to continue expanding its economy and being able to service the debt. The problem is the U.S. is basically becoming insolvent. And so insolvency is just where you can't service your debt payments, or you have more debt than assets, and that's already the case. But right now, with these super low interest rates, the U.S. is still able to afford the service payments on the debt. Now, obviously, if interest rates were to go up or normalize, then that would be a really big issue. But so far, they're super low, and that's the best scenario. The worst scenario is if we have kind of what Peter Schiff is talking about. He's been talking about for a long time, where we have this kind of hyperinflationary depression, where the dollar absolutely crashes, people's savings are ruined, pension funds, everything just, the dollar loses all of its value. We have a kind of like Zimbabwe type inflation, and the economy is basically destroyed in order to service the debts. Now, I see this as, basically impossible in the next several years, if not longer. I think the concern is deflation, and that's because there's so much debt in the system, and there's not a mechanism to actually create more dollars into the system. You have to have credit growth and economic growth in order to really create and input that money into the system. And if you look at also the euro dollar system, international dollars around the world, it's the same issue. There's a huge demand still, even on treasuries, believe it or not, even though they yield nothing. But there's a huge demand on the dollar. It's the world reserve currency. And again, the Federal Reserve can't, even if they were able to input money directly into the US economy, that doesn't mean it's going to be able to fund the rest of the world. And so it's a really big kind of thing to try to conceptualize. But so far, as long as the system stays the way it is, right now, all the Federal Reserve is doing by printing all this money, all they're doing is really just creating more collateral in the financial system, and they're keeping interest rates low. And so what I think we've seen the past several months with basically everything going up in price and everyone talking about how the dollar is going to crash, well, there's no alternative. Interest rates are at zero. No one wants to save. And so what's happening is everyone's investing in anything else that has a potential return higher than 0%. It's pretty simple. Dr. Lacey Hunt really explained it beautifully, talking about lower interest rates. And I might do a whole deep dive video just into interest rates, because it's really important to kind of understand the implications of it. Because it's not just that if you have zero interest rates, things are just going to keep going up in price forever. No, it doesn't work like that. What low interest rates do is it basically takes future consumption and brings it into the present. And so we've had ultra low interest rates for almost 10 years now. We got back up to maybe 2.5% after the global financial crisis. And I think that was back in around 2016, 2017. I don't remember exactly, but we weren't able to get over 2.5% interest rates. And then they were brought back down to zero in light of the pandemic and that whole crisis. So there's no cushion. And all of that future consumption that's been brought into the present, it's going to dry up at some point. And so the question is, when we have another shock to the economy, what is the Federal Reserve going to do? Are they going to lower interest rates again? Well, that's not going to do much, and there are probably more drawbacks to negative interest rates than there are positive things that come from that. It'll really, mess with the financial system, the banking system, but also, if the reason that you're not buying a house right now is because the interest rates, and again, the interest rates on a 30-year fixed mortgage are as low as they've ever been. I think an all-time low. They're well under 3% now. So if interest rates were to go from 2.5% down to 2% flat, is that going to change your stance on whether or not you'd buy a house? It's not going to bring that much more consumption. And so we're at a dead end. And the question is, where do we go from now, and how do we get out of this kind of black hole, this kind of really, really difficult predicament? And that's where the inflation deflation debate comes into play. Hopefully we don't have a hyperinflationary event, but again, I think that's completely impossible given the constraints of the current system. Now, if those constraints, if the way the system is structured is changed, then that could be a totally different story. But again, it's not. And so I can speculate all day as to what the government may do in several years, or what the Federal Reserve is going to do. But again, the Federal Reserve doesn't have any more power. They're already using all their plays in the playbook. And they're not able to get consumer spending going up. We're seeing savings rates at all-time highs or near all-time highs. Are still way above normal levels. It hit an all-time high back in April. But the economic engine is really compromised, and there's not really much that the Federal Reserve can do. And so that's why they've been talking so much about, well, we need more fiscal intervention. We need the government to continue doing these stimulus packages and doing more, because this whole printing money thing, this myth can only go for so long. And it's caused a lot of people to say, oh, the Federal Reserve is printing money. Well, that's going to crash the dollar, and that means stocks are going to go up. So as long as that narrative holds, we could continue to see things continue to go up. But I don't think that's a sustainable way to actually foster an economic recovery, or at least a real recovery. So that's the best and worst scenario. And by the way, a deflationary deleveraging is actually much better than a hyperinflationary one, because with a deflationary deleveraging, or let's start with the hyperinflationary one, it doesn't fix anything. A deflationary deleveraging, it basically washes out all the bad businesses, all the businesses that, not all the bad businesses, but all the businesses that took on too much debt and that weren't creating enough profit and being efficient enough in that kind of economy. And so what it does, you have all that debt wiped away. You're then able to reallocate those resources into different areas of the economy, in different areas where those resources will be more productive. And then it also brings asset prices down. And so it creates more opportunities, especially for those that don't have as much capital. And it creates opportunities for those that can actually use those resources and use them more productively and efficiently than they were being used before. And so people have kind of talked about how it's kind of a creative destruction. Deflation creates opportunities, and it wipes out the bad debt, and it supplies a much better foundation for an economy to then build off of thereafter. High inflation or hyperinflationary kind of environment, it doesn't do that. It really just doesn't fix any of the problems and just bails out the government or people that had a lot of debt, and it just crashes the value of the currency. And it's completely destructive. It's terrible to savers. And this is why I really want to make sure that these kinds of concepts are well understood, because if you have a lot of money in savings and the system is changed and we start seeing the government just be completely reckless and marry the Federal Reserve, and you just have all of this real money printing, not this fake myth money printing where they're just trying to influence behavior. We actually have a real system change where they're just willing to crash the currency and just restart from something else. Well, that's going to be, that would be terrible. And so that's why I really want to make sure that this is well understood and that we know what kinds of things to be looking out for so that we can respond accordingly. So that's the best and worst scenario. So next one, what's the best way to keep value from appreciating or depreciating in assets like my house and savings? So this is kind of a relatable kind of question. So when we're talking about value, and I'm probably going to make a whole video about this, but price and value are not the same thing. And so when we're talking about assets like real estate or your home, the value, like what we had in the 2008 financial crisis when the housing bubble burst, those houses, they didn't lose 50% of their value. Their price went down, and that's because there's too much supply, and there's a massive bubble in real estate loans. And so when those started going bust, now the supply exceeded the demand, and so people weren't willing to continue to buy homes, or at least not as high at as high of a price. And so the value didn't go away; the price did. The price is what depreciated. And so it really depends. I mean, for a home, if you are, it really matters for first time buyers. It doesn't really matter for people that are looking to enter the market. If you already have a home, then you're fine as long as you have savings and you're able to kind of sustain economic instability. Because a home, a house, especially one that you're living in, it has direct utility. You're not in it to make money. You're in it to have security, and hopefully build up an asset over time if you haven't paid for it, or if you don't have 100% equity yet. And so, yeah, nothing really there as far as that's concerning for owning a house. So for first-time buyers, and I'm not 100%, I don't know a ton about real estate, but this is what I'd say as far as looking at macro. So for first-time buyers that don't have a bunch of money and looking at these housing prices is just ridiculous, what you can do, I would say renting is the best strategy right now compared to trying to buy something right now. And the reason for that is prices are just super high. And let's say you don't have a lot of savings and you have this kind of economic deleveraging that happens, especially if it's deflationary. You're not going to be able to continue paying the mortgage for that house, even though it's super low interest rates. It's going to get really tough, and that's something that I think people have to understand. Now, if you do have a lot of savings, then you could get that super low 30-year fixed rate, as long as you've got a lot of money and a lot of cushion in order to be able to continue making those interest payments over time. Then getting a 30-year fixed rate below 3% is just unreal. So if you don't have a lot of money, I would say renting is the best option right now, because getting committed into something at astronomically high prices, you might have to, when you do want to buy something in the future, you might have to pay a higher rate. But it's better to do that when you're in a better financial situation rather than take on so much risk in these uncertain times and get into a home that's its price is just completely inflated. And so that's kind of my 2 cents on homes as far as real estate goes. And then savings. So this goes back to the inflation deflation thing. Is your savings going to go to zero? And that's if the dollar crashes. Well, it depends on which part of the debate you fall in. If you're in an inflationary camp, then you're probably saying, okay, you need to invest that money, because if you just hold it in a savings account, or if you hold it under your bed or whatnot, it's going to go to zero. And so you want to buy hard assets or companies that are creating value, goods and services, and put it into something that's actually going to hold its value, that's going to produce value. And if you are on the deflationary camp, and I'm on that side just because I think that's where the facts kind of lie. Again, things could change in the future that would then make me much more concerned about inflation. But right now, that's all speculation. I don't know what politicians are going to do in office. I don't know how people are going to respond. But I do know that right now, the biggest concern is deflation, given the structure of the system. And so what I'm doing is trying to save as much money as I can, because I do think the US dollar is going to gain value relative to other assets. And again, this is where we kind of talk about price and value. There's no value in US dollars or in paper currency, fiat money. It's just they're just pieces of paper. There's no intrinsic value. What I'm looking at is, given the abstraction of money and how everything is set up, right now you can't take a block of gold and buy gas or buy groceries or pay your rent. Given that, I don't think Bitcoin's there yet either. I think there are going to be a lot of people, given a debt crisis where businesses go bankrupt, jobs are lost, and there's this kind of realization that this economic recovery is not just not yet underway, but the contraction really hasn't started yet. I think people are going to dash for cash, and that's going to crash other assets as people are looking to be much more concerned about safety, security, and liquidity, having cash available in order to continue to, pay for the essentials and stay secure and safe. And so my whole approach is that the value for all these things, like gold, like Bitcoin, like stocks, that, all these big internet companies, technology, all these big movers, all these big opportunities, there's a lot of value there. And so I think the best approach is being very conservative and being, not trying to take on unnecessary risk, and then waiting for those prices to come down. And then in taking that savings, taking that worthless fiat currency and putting it into some of these things that have value at much lower prices. And then that's kind of my investment thesis that I'm looking at. I'm just going to be very conservative and wait for things to come down to lower prices. And the reality is that maybe it's right. Maybe people in the inflation camp are right, because the government will not want to default on the national debt. How far will they go in order to not default? And that could come with policy change and really change the system. Well, if that kind of thing happens, then I'll be the first one to say, okay, inflation is the big concern, because now they can actually print money. Now this becomes a big concern about the dollar actually retaining its value, and the supply of money just flushing into the whole economy. That could become a concern. But until it does, or until prices come down to fair value, I'm not going to be trying to over leverage into risk assets, because I see a really, really vulnerable economy that's completely dependent on massive amount of debt. And so that's kind of what I'm looking at. So that was in response to savings. Yeah. So keeping value in savings. I know it's a tough time for savers with 0% interest rates, and everything else is going up in price. So in real terms, you're losing value on your savings. Or you're technically losing price, price purchasing power. But that's the way I see it. I don't see an economic recovery yet to actually justify why things will just continue going up in price. And I also don't see the structure of the system enabling this kind of price appreciation to continue inevitably. I think this is a speculative bubble that's being caused by people not really understanding how the system actually works, and thinking that the Federal Reserve and the government are just backstopping everything and just going to allow it to just keep going up. And yeah, I think both of those are just not founded. And so eventually, when things come to reality, there is going to be a deleveraging. I think that's going to be deflationary, and I think that's going to cause asset prices to go down. So that's why I'm taking the conservative approach. And as far as keeping savings, safe and not losing your savings because the dollar crashes, I don't think that concern is there. Especially if you have it in cash or long-term treasuries or whatever it is. And again, I don't know a lot about the concerns about bonds. That's a whole other conversation. But definitely not high-yielding bonds, because if companies go bust, then their bonds, they're not going to be able to pay. They're not going to be able to pay, and so those bonds are deemed worthless at that point. So not investing, only investing in the absolute safest bonds, highest grade bonds, if you're wanting to kind of have that liquidity, but also maybe a small return. But yeah, that's not, don't take it from me. There are other people that know a lot more about bonds. You could check out Stephen Van Meter, and I think Dr. Lacey Hunt. He's been on the kind of bond bullish side. So anyways, that's that. Next question. All right. So considering you watch content from George Gammon, oh, give me just a second. Let me plug in my computer. It's getting a little bit low. All right, cool. All right. Considering you watch content from George Gammon and the like, and considering how you believe deflation is coming and inflation may follow after, to what extent do you personally believe these potential outcomes are being deliberately produced or sought after by those who have an agenda? So that's an interesting question, and this is the way I look at it. I think there are a lot of people that understand what's really happening. And one thing is, if you look at the banks, they're basically telling you what's happening. If you look at interest rates, they're basically telling you what's happening. Interest rates being super low is basically saying future expectations on returns are extremely low. That's basically what interest rates are telling you. And so that's why I'm extremely bearish on the stock market, because the only reason why everyone's flooding into the market and why the market's going up is because people can think that they'll be able to continue selling stocks at higher prices, and that the Federal Reserve and the government are just going to backstop the stock market. I saw a hilarious meme the other day where someone it was like showing how I figure out what I'm going to invest in next, and it was just someone that it was just like a robot that slammed its head into the keyboard and would just move its head, and just like whatever stock pops up when I randomly input these letters, I'll buy that because it'll just go up. And that's kind of the rationale at this point. It's not that anything fundamentally is driving these stocks. It's really more of a speculative kind of mania. And so, but the reality is, I think a lot of people understand what's happening, and I think a lot of people understand that it's going to be really difficult. And I think this is going to culminate in a kind of wealth transfer that we haven't seen in many, many decades. And if we just look at the banks know what is happening. That's why they're not lending money. If inflation was a real concern, banks would be lending money, because if they're holding reserves or they're holding cash equivalents and they see inflation going up, well, inflation produces higher consumer prices, which hurts the relative value of dollars. And so if the value of the dollar is going down, well, banks are going to want to lend money in order to get interest in return, in order to keep up with the times. They're not going to just hold all their cash while inflation is going up. They're losing money. And so given that it's very clear that banks aren't lending money, they are very geared up for deflation. So there are a lot of people that understand that this is going to happen, and they're holding safe, and they're keeping cash available. And also, I think this is a huge thing. This gets even deeper when we start talking about economic systems, and talking about kind of how capitalism has created the wealth disparity that we see today. And I would say that the manipulation of currency, and just so many things that have really kept the poor and continued to boost the rich. And we've seen that Elon Musk is now one of the most one of the richest people in the world now, from Tesla stock going up sixfold in light of the biggest contraction in GDP ever, and in just a completely terrible economic situation that's boosting everything. And so it doesn't make any sense, and it's widening that wealth disparity. And so I think a lot of people are wanting to continue to propagate and perpetuate these myths about how capitalism is creating this. And I'm actually going to make a whole video on, I don't know if you all have heard of the World Economic Forum, but there's a bunch of content out there. You can, YouTube and, check out what these people are saying. And they're already talking about how you will own nothing, rent everything, and be happy. And you have to ask, well, if I'm going to be renting everything and owning nothing, that's no property rights. That's kind of getting into communism, where no one has property rights. You have to ask, well, who's going to own everything? Who am I going to be renting from? And so I think what we could see in this kind of situation is where a lot of people are going to lose their shirts, and they're going to be really desperate for whatever kind of transition there ends up being, especially if it's all attributed to capitalism. Well, you're going to have a completely different economic system thereafter in order to rectify the issues that capitalism created. We're in late stage capitalism, and there are definitely issues with capitalism, don't get me wrong, but we haven't had kind of a free market system in a lot of areas that would actually create a lot more opportunities for people, and also create lower prices so that we're not pushing so many people out. And I could get into all of it. So anyways, what could really happen is where the people in power that really understand what's happening and are kind of, ahead of all this, where they can continue to buy up all the assets as people go bankrupt, or, people foreclose on their homes. And where we kind of have the system where the 1% own everything. And that's a very, dystopian kind of, vision. And it may have sounded conspiratorial a year ago, but a lot of these things are being said by those at the World Economic Forum, and it's very concerning because people are on the complete opposite trade. They think that everything's going to continue going up in price, and if that's the case, well, then everyone's going to get rich except those that don't own assets. And again, the structure of the system isn't even in place for that to be a possibility right now. So I'm not going to speculate on that. And this leads into another question: thoughts on Warren Buffett buying Barrick gold stocks. So Warren Buffett, one of the greatest investors of all time, obviously. And he earlier this year opened up a position in Barrick Gold, a gold mining stock company. And I think it was only maybe 0.25% of his portfolio, maybe 0.5%, which is like $300, $400, $500 million. I don't know how much money it was, but it's a lot of money. So I wish, imagine your portfolio being that big to where 0.5 or 0.25% of your portfolio is $500 million. I mean, that's just unfathomable. But I actually heard that he sold about 40% of his position in Barrick Gold recently. The reason why I think Buffett still retains a Barrick Gold position and entered one several months ago, well, the economy was in disarray. A lot of people were really concerned. Real economic growth is going down, and so that creates a lot of uncertainty. And gold usually does pretty well in uncertain times, especially with low interest rates, because now you don't have, your savings isn't paying anything. And so you can get a higher return by obviously going into the stock market, buying up risk assets, but also buying something like gold, especially in uncertain times. A lot of times people go to to gold and other kinds of alternative commodities, and also the US dollar, in order to kind of find that safety. So I think he was, buying it for those kinds of reasons, and gold did shoot up. We saw it go over 2,000. It's back down to around 1,800. And also, that if you're on the inflation camp, you think gold is going to skyrocket and it's going to hold its value. And I completely agree that it would hold its value in an inflationary environment, except I don't think we are in one. We're in a disinflationary one. And if when we have the next economic shock, in 2008, it was Lehman Brothers going under. That economic shock that brings that reality of insolvency, of an insolvency crisis where businesses are just not able to continue to pay off their debts, that's what can really start creating this kind of domino effect. And gold, again, if gold was money, well, gold is money, but if gold was the currency that is deflating, then yes, it would. But again, you can't take gold or gold coins or gold bars and use those to pay your rent or pay for essentials. And so given that I'm on the deflationary side of things, I don't think gold is going to perform very well. That doesn't mean it's not going to hold its value again. Again, the gold's value is there because it has intrinsic value. It's used in a lot of different things, technology and all that. But it also has the important foundations of money. And so that's why a lot of people think we're going to have a currency crisis and we're going to go back to gold. That's a whole other conversation. But I don't think the price of gold is going to fare well in these kinds of economic environments that we're heading into. So he did sell about 40% of his gold. Some people are attributing that to the vaccine being authorized. And so that's creating more optimism towards a recovery. And so that is not great, I guess, for gold as far as having an investment thesis that gold does well during uncertain times. So I think that's probably a reason why he lightened up. And also gold is a leveraged bet on inflation. Just like I would say Bitcoin is kind of a leveraged bet on inflation. And that just means that you could get more for your money if you're right. And so gold, owning a gold mining stock gets you even more return if you're right on inflation compared to gold. Because you also get the profits from that gold mining stock. So I think he was going for the leveraged bet there. And it's interesting too, because Warren Buffett has always been very negative about gold. He's always talked about how, it has no utility. It's just, it doesn't pay you dividends. What's the point? It doesn't produce any value. And so it was interesting, several months ago seeing that, and now he's apparently lightened up his position. But again, it's a very, very small position. And it doesn't really change my standpoint, because Warren Buffett is also holding a historically high proportion of his portfolio in cash. So, I think Warren Buffett understands that the economy is still fractured and that a vaccine is not going to change everything and not going to provide this automatic economic growth. And so I think Warren Buffett's going to do what he did in 2008 and 2009. He's going to be ready to swoop in when assets get really cheap, and he's going to use that cash and, go in and buy things when they get ultra cheap. So yeah, that's kind of my thoughts on Warren Buffett owning gold mining stocks like Barrick Gold. Next question. So why are we in so much debt? And also, I just wanted to mention that I don't think I've gotten any questions on the live chat, but if anyone has any other questions that they're viewing right now, feel free to drop them in the chat box. And, these are just questions that I've already received from other social media platforms or previous videos. So feel free to, drop any other questions that you have. But the next question is, why are we in so much debt? Is it because our Federal Reserve and government have been hijacked by a bunch of criminals that are pushing us towards servitude? How can we address the problem from its roots? Well, the debt issue, and it's kind of like, 5 trillion, 10 trillion, 20 trillion. It all becomes impossible to kind of conceptualize. The reason why we're in so much debt, first of all, the structure, if we look domestically, we look at the US, why is the US in so much debt? Well, the structure of our economy, we're a service economy. And so we're not producing a lot of things and then exporting them. And so that means, given the fact that we don't have this kind of infrastructure built in and stuff like that, we're relying on other countries to produce things so that we can then import them here. And what do we give them in return? Well, money, or we give them debt. A lot of times we sell our own debt in order to get things now. And that might sound weird. Why would someone buy our debt? Well, U.S. debt is one of the probably the best form of debt in the world, and that debt can also be exchanged in other transactions down the road. And so countries can use that as an asset, owning U.S. debt. So, and China, I think, owns the most debt as far as a country. But the U.S. owns the most debt out of anyone. I think we own like 70% of our own debt, and it's just debt everywhere. But that's a big reason. The structure of our economy, we're a service economy, but we still need different kinds of commodities and raw resources and other things that we don't create in this country. And so we need to buy them from other countries, and we exchange our debt for that. And we've been doing that for a long time. And that's one thing that's created a lot of debt. There are many other things, but that's kind of an example. We consume more than we produce. And so that's what's created this massive kind of debt bubble fundamentally. Another thing is the currency we use. It's paper currency. There's no value. There's no fixed supply. So when we were on a gold standard, we couldn't just continue to inflate our money supply because it was backed up by something that had a fixed supply. Now we have a fiat monetary system where we can expand it at will, and we can go into as much debt as it just opens everything up for the government to be able to do a lot more things, which creates a lot of moral hazards, and just pushing things, kicking the can down the road for big issues like this. So that's a big thing. That's also why I'm not so sure that we would ever go back to a gold standard, because if we have a gold standard, then that prevents the government from being able to manipulate the currency supply and do as many things, because if it's actually backed up to something that has a finite supply, well, then you can't do as much with it. So that's kind of a other point. But definitely the money we use, it's not money, the currency we use is a big reason why we have so much debt and why it's ballooned to such astronomical levels. And then also low interest rates. So if we had this much debt, we had high interest rates, so there would be no way to pay them. And interest rates, it's not just in the US, all around the world are ultra low. And so, we in Europe, and I think Australia too, they have negative interest rates. In US, the US has never gone negative, but we're not far from it, which is pretty crazy. But low interest rates have allowed for people to continue, or countries to and people to continue to consume more than they produce, and continue to bring in future consumption, as Dr. Lacey Hunt has explained, bringing in future consumption from the future into the present. And that's what low interest rates does. And it's not like you can just keep interest rates low and prices will just continue going up forever. No, you're only bringing a certain amount of consumption into the future. And at a certain point, the risk outweighs the reward for holding on to risk assets. And that's what creates those kinds of massive bubbles. And then when that bubble pops, then everything kind of resets. And again, the question is whether or not that bubble is going to turn into a dollar bubble, or if it's going to turn into, an asset bubble. So next question. So is government stimulus inflationary? So this is a really good question because they're already talking about another $1 trillion stimulus package. And as far as the inflation deflation debate goes, well, if they're going to just continue doing all the stimulus, then, that's going to continue putting downward pressure on the value of the dollar. So this is a really important kind of thing to wrap our minds around. And there's a lot of nuance that goes around it. I'm not going to even act like I understand everything behind it. But stimulus, the way that the government is able to afford these kinds of massive stimulus packages is they issue debt. And, this, we can go back to the 1930s when you had World War II. And, the US government issued a bunch of war bonds in order to pay, in order to finance the war. So a bunch of people bought those war bonds, and that's what actually created that money in order to pay the war. It didn't create new money, it redistributed that money. And so when we're talking about stimulus today, well, how is stimulus, how were we able to pay these massive stimulus packages earlier this year? Well, foreign investors, domestic investors buy the U.S. debt, and then that's what finances these massive stimulus packages. So it's not technically inflationary because that money is not being created. It's not coming from nowhere and then just appearing. It's being redistributed into different parts of the economy. And so that's a huge important thing. So it's not inflationary, but it could be price inflationary. Now, again, I say could be because it's not technically. It depends on what that money is used for. So let's say if it's price inflationary, what would cause the government stimulus to be price inflationary? Well, if people that get that stimulus start using that money to buy discretionary goods and services, they start increasing their consumption. That would be in price inflationary because now you're increasing velocity and people are buying more things, and that pushes up demand on goods and services, and therefore prices would follow as well. Now, if people use that stimulus to, let's say, just continue to pay their debt or put it into savings, that's not, well, savings is basically neutral. But if they use that to pay debt, that's actually deflationary. So that's how stimulus could actually, in theory, be deflationary because it's just allowing people to use currency that's been redistributed to them in order to wash off their debt. And again, when I used that example earlier in the live stream talking about how there's more debt than there is currency in the system, if you create a mechanism that doesn't create new money, but it just redistributes it to areas that need it the most, then what you do is you just accelerate that debt, that kind of collapse between debt and currency. And that's what can create a debt deflation, and that could be really destructive. Now, the other part of that, and this is what I talked about in my last video, is if the Federal Reserve is the one that finances the stimulus. So let's just say, there's another massive, let's say next year they do a $5 trillion stimulus package and they're just going to, rain money all over the economy. Well, let's say there weren't enough foreign investors or domestic investors, or let's just say, well, we're not even going to, issue these bonds to any investors in the public economy. We're just going to go straight to the Federal Reserve, and they're going to finance the whole stimulus package. That would be massively inflationary because, again, the Federal Reserve doesn't have any money. And so what would basically happen is just like it happens with the banks. It's just quantitative easing. All it is an asset swap. The Federal Reserve gives the banks bank reserves, and the bank reserves give the Federal Reserve bonds. And that's what prints money, but it's not really printing money because, again, none of that money is entering the system. Now, what could be inflationary for stimulus is if the Federal Reserve starts directly financing all of the stimulus. And so that's basically where the government issues this massive $5 trillion stimulus bill. And what the Federal Reserve does is say, okay, here's your $5 trillion. You give us all the treasuries, and it's a deal. And the Federal Reserve has no downside because they do have a bottom line, but since they don't have any money in the first place, they're just creating it out of thin air. So that would be money printing, and that would be seriously inflationary because now, depending on how much the government wants to see inflation, that's the direct mechanism. And that would create new money from nowhere entering the economy. So if, the Federal Reserve and the government kind of marry each other, so to speak, that's what could be very inflationary. But alone, government stimulus is not inflationary. It can create price inflation in the short term if people are increasing their consumption. But if they're using it to pay debt or save money, it's not creating price inflation. And it could actually even be deflationary as there becomes less money in the system. So that's kind of that spiel on that. Yeah. Okay. So the next question is the M2 money supply inflationary? So is the M2 money supply rising inflationary? Okay. So what we saw back in earlier this year, the M2 money stock just exploded. For those that don't know, the M2 includes savings. I think I have it here: savings, checking deposits, time deposits like CDs, and also money market funds and institutional money. So it's the broadest money measure that we have when we're looking at the domestic economy, and it rose like crazy earlier this year in light of the stimulus. Now, again, a lot of people said, oh, stimulus, M2 going up, that's massively inflationary, money printing, blah, blah, blah. Well, not technically, because again, the M2 only takes into account the domestic economy. The US dollar is a worldwide currency, it's the world reserve currency, and so there's a massive market outside of the US. So again, let's say foreign investors bought up a lot of US treasury bonds, which we've been seeing actually an increase in 30-year treasury purchases from foreign countries and investors. If they're now they're buying treasuries and then sending us money basically in order to fund those stimulus packages, that can be that's not inflationary. It's not creating money out of thin air. And so Jeff Snyder is one that talks about the Eurodollar system. He's extremely brilliant. And he talks a lot about how the M2 is not comprehensive. And so just because the M2 rises, that doesn't mean that new money is being printed or created out of thin air. It just means that new money is hitting those checking deposits. It's hitting those money market funds. And it's basically more money is being registered. But it doesn't necessarily mean that we're having this kind of massive inflation. And if we did have this kind of massive inflation, then we would expect that, first of all, we'd see it in the CPI, consumer prices would be going higher, and interest rates would be going higher. But we're not seeing that. And we'd also see banks loaning money. If inflation was really a real concern, banks would be willing to take on more risk in order to make money in that kind of inflationary environment. Because if banks are just holding on to treasuries and bank reserves and whatnot, they're not going to be making any interest because they don't have any loans. They're not doing any lending. And so they're not going to be able to get those interest payments that can help them continue to be profitable in an inflationary environment. So that's a really big kind of thing. We can, if we know what to look for, then we can be ahead of the curve. We can understand when it warrants us to make an adjustment or maybe to start investing or whatever. But kind of the moral of the story that I'm trying to get across is there's just so much risk right now, and there's so much that we don't know. But what we do know is that there's a massive debt crisis, and the structure of the system is not accommodating an inflationary deleveraging. There's too much debt. It needs to be washed away. How can it be serviced? Is it going to be printed into oblivion, or is there going to be a debt deflation? And the other kind of scenario is where there could be a debt deflation, asset prices start collapsing, and then in response, the government does something in order to try to alleviate that and create more inflation. And if that is a meaningful kind of change and it changes the system, then basically the debt deleveraging could turn from deflationary into inflationary. Again, this is crazy. There's a lot that goes into it. But if we know what to look for, what we can do is, do the strategy that works best for us, for you and your own individual kind of circumstance and your own situation, what works best for you given your circumstances, and also what makes sense in the macroeconomic lens. Because again, just because we might agree on how things are going to, unfold, it doesn't mean there's some kind of fixed cookie cutter kind of strategy that's going to work for everyone. Everyone has different needs, goals, priorities, all that kind of stuff. And so, but whatever works best for you in order to get yourself through this kind of time, because there are going to be a lot of great opportunities and hopefully a much better world ahead of us in the future. But there's just, there's a lot that's coming down the pipeline that could be really difficult for small business owners, businesses, and individuals alike. And so that's why I try to take this kind of big picture view on things in order to kind of simplify everything, because it's really, really easy to get caught up in the weeds and kind of resonate with something that makes so much sense. Fiat currency, it's worthless. They're going to print it into oblivion. There's all this kind of stuff. And so I hope that me kind of digging into it a little deeper, explaining the system and how we can kind of protect ourselves, have that security in these very, very uncertain times. So yeah, that is the last question that I had on here on my notes. And let me check just to confirm I didn't miss anything. Still kind of getting used to navigating this whole live stream format. Okay, so I have live chat. How do I see it? Pop out chat. Let's see. Okay, I don't think I have any questions on there on the chat. So we didn't get any additional ones. I got all the questions from Instagram and previous YouTube videos. And I think I covered a lot of those. So if there aren't any other questions, then we will wrap it up. Thanks so much for watching. Those that that have been watching, it's I really appreciate it. And I hope a lot of this kind of cleared up some things. I was aiming to do a whole deep dive into my last video when I was covering inflation, because I've been really harping on deflation because I think that's the big concern. And so I was going to dive deeper into those inflation indicators. But I figured, well, since no one posted any questions specifically about those indicators, that means hopefully I did my job to make it pretty clear and understandable. And I figured I could kind of get into a lot of those points on this video, which I did, talking about stimulus and, the Federal Reserve and printing money and, kind of all that kind of stuff, and where those concerns about inflation come into play. Because again, prices are going up, stocks are going up. But again, it's really easy to get caught up in what's happening in the short term. But when we zoom out and look long term, it can kind of help us understand what are the biggest risks and how can we put ourselves in the best situation to be able to deal with those bigger risks. Because again, anything can happen in the short term. So yeah, as long as we know what's happening in the long term, we can set ourselves up to be in a much better position and not be a victim in light of everything that is happening right now. So anyways, thanks so much for watching, everyone. In my next video, I'm going to be doing kind of like an in-game and looking at what do I see happening in the next several years, given everything that we've kind of talked about, and how can we kind of build a roadmap in order to navigate these uncharted waters effectively and ensure financial security and all that good stuff. So I'm going to be getting into that hopefully next week. I hope everyone's enjoying their pre-Christmas break, and I will see you all next time. So thanks for watching.